Thanks a lot, Sneha, for that. Good afternoon and welcome to the Market Closing Show. This is our collab show between Business Today and India Today Television. This is 3 p.m. show and here are all the closing action updates that you need to know. First up, let's take a look at what's hot in corporate and financial world. After a two-day rally, Indian stocks trade lower. Sensex fell over 100 points, Nifty below 26,200 with the realty metal stocks leading the losses amid weak global market trends. William Brain's Garage Ventures, the parent company of Grow, has posted a 12% year-on-year surge in its Q2 profit, the first quarterly earnings after it got listed on the stock market, sending shares up by nearly 7% after 2 days of a fall. Notably, 36% of new users in Q2 FY26 were SIP first mutual fund investors. Capillary Tech shares list weak at 560 rupees versus issue price of 577 rupees, but stock rebounds over 12% post-debut. IPO worth 877 crore rupees was subscribed 52.9 times. Meanwhile, Sudeep Pharma's 895 crore rupees IPO is fully subscribed on day one. Price band at 563 to 593 rupees per share. Crypto market slide deepens as Bitcoin tumbles below $86,000, its lowest level since April. The token is now down nearly 30% from its yearly peak, wiping out about $1 trillion in market cap in the recent weeks. Total crypto market valuation has dropped to $1.7 trillion. US will increase travel and immigration fees from January 1st of 2026. Parole and visa-related fee will also go up slightly, while the arrival and departure form fee will stay the same. Let's straight away look at the top breaking news at this hour. The rupee has hit a fresh record low against the dollar. It has fallen 80 paisa from the previous close, and right now the rupee is trading at 89.48 against the dollar. Remember, this is right after when we have seen there is seeming to be a missing action from the Reserve Bank of India at this stage in time that has led to a sharp fall in the rupee in just the last 10 to 15 minutes odd. Earlier, what we have always seen is that the RBI has always intervened in the previous few months whenever the rupee slipped to 88.7, 88.8, thereby selling the dollars to put the strength behind the rupee. This time around, the RBI has not intervened, and therefore you see a sudden sharp fall in the rupee as well, now to these record low levels as well. 89.48 against the dollar is what you're seeing the rupee fall at. Let me quickly welcome our guest on board to understand what has really happened and what would this mean for the investors at large. Sharmila Joshi is now joining in, our market expert of the day. Hi Sharmila, warm welcome. Good afternoon to you. Well, before we come to the markets, it's all about the rupee right now, a sudden sharp fall. What do you think is the key reason behind this?
Well, I think there could be a number of reasons. One is, of course, I think what a lot of market participants have been talking about for the last couple of days is the fact that yields in Japan have gone up. And that seems to have sort of triggered a chain reaction across the globe. For instance, you are seeing, you were discussing a little while earlier, the kind of correction that you're seeing in Bitcoin. So I think it's a kind of a ripple effect that is taking place across the globe, because sort of an unprecedented event seems to be unfolding. So we need to track that closely. But other than that, very honestly, I don't think that there is any sort of disruption on our macro front to sort of indicate why the rupee should open weaker.
Absolutely. How would you look at the markets at this stage? Yet again, we are seeing some pressure build up onto the markets to 26,071. Yesterday, we were celebrating 26,200 kind of levels. But this again, we are looking at selling pressure at those higher levels. Why do you think the markets are consistently failing to go above a certain level?
See, I think the good news that we can take away from this seems to be that FIs have turned buyers. And I think the indications seem to be that they are buying net. They should be net buyers today as well. So that could possibly be the second or third day of buying that we would be seeing from FIs after a long time. So that is the good news. I think there, you do need, as you're saying, we are seeing a market that seems to go up and then sort of fizzle out a little bit and then go up, when there is another piece of good news and so on. I think there is both a good and bad to that, because obviously I think the support is coming from the earnings, and earnings, as everyone is talking, are definitely have been better in some of the sectors than anticipated. Also, since the market has been range bound, we are no longer an expensive market the way we were a year ago. So that should give market, sort of a firm foundation to sort of build on. But the kind of mixed global cues that we are getting, once again, you're hearing of a correction in Nasdaq because of which is sort of supposed to be your AI fronting index, because of the kind of lot of talk that has been going about Nvidia and the kind of investment that AI requires, and whether it's going to be really, is it a bubble or is it really going to amount to anything, and so on. So, there are a lot of mixed signals in the market, and they will have their effect, because, we are not an insulated market anymore. But that said, as I said, I think, we have enough of positive signals as well, and hopefully those should play out in days to come.
Fantastic. Meanwhile, viewers, we are given to understand, some of the traders do have pointed out that RBI has likely intervened at near 89.50 levels to arrest the rupee slide from here on. So things seem to be have caught the RBI's eye at the right moment, but the rupee has fallen beyond the 89 per dollar mark for the very first time today. In fact, the biggest intraday fall since May 23rd of 2025 is what we've seen. The rupee has fallen more than 1% on an intraday basis against the US dollar at this point in time. But rightly, the RBI has intervened and has arrested the fall at about 89.5 levels. That's something that you can definitely keep an eye out on as well. When it comes to the asset classes that investors are looking at very, very clearly, the real estate investment trust, the InVITs particularly, there is a proposal that has come in from the Sebi, the capital markets regulator. Sebi has proposed major changes to boost the role of real estate and infrastructure trusts in Indian market. The regulator now plans to classify real estate investment trusts, that are REITs, and infrastructure investment trusts, that are known as InVITs, as equity instruments, now paving the way for their inclusion in popular equity indices. At the same time, mutual funds are also set to get increased exposure to these instruments, opening up fresh capital flows and investor interest. Sebi has emphasized that governance, transparency and investor protection will definitely remain non-negotiable as these newer asset classes gain scale within the equity markets. Let's try and understand this a bit, but first up, let's listen into what the Sebi chief had to say.
नहीं, जब वो इंडेसेस में कोई भी इंक्लूड करने के लिए जब आपकी लिक्विडिटी बढ़ती है और जब AUM बढ़ता है तो उसमें एक पॉसिबिलिटी होती है करने के लिए. आई थिंक MSCI इंडिया का ऑलरेडी उसमें है, तो इंडियन इंडेसेस में वो बढ़ेगा जब वो उसका हिसाब से इंडस्ट्री और वो साइज बढ़ेगा, सो दैट दिस एसेट क्लास गेट्स इंक्लूडेड एज वन ऑफ द मतलब उनके नियम हैं, जो इंडिसेस के नियम हैं वही फॉलो करेंगे. द आइडिया इज दैट वंस इट इज इंक्लूडेड इट विल हैव add more liquidity to these instruments. Mutual fund तो ले ही रहे हैं. I think MP chairman also mentioned, and now we have done that classification. Mutual fund के लिए पहले ये hybrid classification में आते थे दोनों, जो both REITs and InvITs used to be at the same classification for the purpose of mutual funds. We have said now that the REITs will be classified as equity for mutual funds, and InvITs will continue to be in hybrid. So that will also add clarity and more elbow room to the mutual funds to invest into this industry.
All right, Sharmila, coming back to you, do you think this could be a big push to investments in REITs and InvITs by way of getting a greater access in equity mutual funds going forward from here? What do you think also investors stand to gain with this kind of a proposal?
So I think it's very good news, very honestly, because we've had REITs as an instrument for quite some time, REITs and InvITs, but they've not really picked up in popularity. So, to my mind, this indicates two things. One is that, as your market grows more mature, which is certainly something that we are seeing in our markets, then you will require sort of different products and more products with layers, not straightforward products, but sort of more layered products to enter into the market. Also, I think for REITs and InvITs, what it means is that simply because your product is tied to real estate, very simply put, these are instruments that would be give you a sort of a steady rental kind of an income because they are investing in either commercial properties or InvITs would be in sort of infrastructure plays. So that again, I think that would bring a lot of structure to that market as well, because you would really then see big developers and sort of global players entering into this field, and we have a lot more left to unfold in terms of both commercial real estate, infrastructure play, etc. So it would give, I think, wings to that as well if you were to see a more structured market there where you can sort of manage your risk better. So I think it's great news, and you will be able to trade. It will be a liquid instrument for you to trade, so you will be less afraid to buy it because that has sort of prevented people from buying into it because they've been illiquid. So I think from all fronts, to my mind, this sounds like a really good move.
Fantastic. Okay, so more exposure to REITs and InvITs can actually be seen on regular retail investors' portfolios with increased access if this proposal is to go through. Let's focus a bit on, some of the conglomerates and how some of those stocks are, in focus today. Let's focus on the Adani Group first. Adani Enterprises, viewers, has sold the remaining 7% stake in Adani Wilmar through a block deal today, officially ending its decade-long association with the company. With this transaction, Wilmar International becomes the sole promoter, marking a significant shift in the ownership structure. This move also concludes Adani's journey in the edible oils and packaging foods firm, giving full control to the Singapore-based promoter and paving the way for new strategic chapter of the company as well. Right now, if you look at the stocks are still hovering lower because the entire market is also on a subdued note at this point in time. The Adani Enterprises stock is also down by nearly 1% right now. Let's try and understand what this means. Sharmila, coming to you. Adani Enterprises now taking a complete exit. This was, of course, expected. Earlier this week, they had also sold 13%. Now the 7% remaining stake has gone. So Adani Wilmar completely exits the Adani Group portfolio with that. This stock had come in with a big bang promise. It delivered handsome returns to investors. For those who got the stock in early IPO investments. Thereafter, of course, a lot of volatility was there, and now Adani Group is exiting from this. How do you look at Adani Enterprises, a move that is, going to be definitely important to look at this stage?
Yes, so personally, it's a business I like, the Adani Wilmar business, or now owned by Wilmar, because whether it is startup or what we've seen from a lot of the other leading business houses, because I think that when you're talking of the sort of the array of goods that they had and the kind of requirement there is on a pan-India basis for such a service, and to set up whether it is hypermarkets, supermarkets, deliveries, delivery stores, etc. I think there is a lot of money to be made in that, and I'm very positive on the space per se. But perhaps it didn't time very well with the rest of their portfolio, where they are really sort of positioning themselves as disruptors in the infrastructure space, as they've said repeatedly. So then it doesn't really fit into that kind of play, and maybe that's the reason they took the exit. But all things said, I think as I said, it's a business that I continue to like, and within their fold also they still have businesses that you like. So you just have to look at the group minus one company now.
Fantastic. Okay, let's look at the other conglomerate, and that's led by Reliance Industries. When it comes to exits, even Reliance Industries has now stopped Russian oil importing now. They've come out in the open and said the same, to its export-oriented refineries, and this is to comply with the European Union ban on Russian origin fuel as well. Remember, Reliance Industries is India's largest fuel exporter, as well as the country's largest importer of the Russian crude oil, accounting for almost half of the Russian oil flows into India. And with Reliance Industries now completely stopping its Russian oil imports, this is going to be of extreme importance. The stock also hit a 52-week high level in trade today, and the focus is coming back onto the stock price yet again. Also, the other part would be, what does this truly signal? Does it signal that there could be paving the way for the much anticipated US-India trade deal with at least the biggest oil importer of India, Reliance Industries, now completely stopping Russian oil. Let's try and understand this with Sharmila. Sharmila, how do you see this step?
Yeah, precisely. That's what I thought of first when I heard this news, that maybe this is sort of signaling that we are close to, and market has been sort of, you have been hearing the murmurs in the market that we are very close to a trade deal, and maybe this was sort of the final piece that had to fall into place, and now the formal announcement is out there. So this could have been done with a view to paving the way for the US trade deal finally to be in place. So we'll watch the news for that. For Reliance, what it means as a company, I'm not really sure at this point in time, but the stock price seems to suggest that it's being received well.
Yeah.
But as I said, I think our focus now should be on whether we are close to getting the trade deal done or not.
Absolutely. So that's as far as the trade deal is concerned, and of course we continue to focus on that part as well. Let's also focus on what's happening in the world of the food delivery space as well. We always track for all our viewers shares of Zomato, Swiggy, and a lot of e-commerce companies, but there is something else that all our viewers must take note of as well. Now remember, the big question is about to share or not to share customer data. A near decade-long dispute between restaurants and quick delivery platforms now seems to be concluding soon. Quick delivery platforms like Zomato have said that it is working with the NRAI, that's the National Restaurants Association of India, to share customer data and to tailor their needs, food choices and preferences. But what do customers have to really say about it? Will their consent be taken? That's what at least the food delivery giant has indicated for now. To discuss all of this, let me just go across to my colleague Aishwarya Patil, who's standing by to give us more insight onto this. Aishwarya, first up, I think the big ask that restaurants are doing with the food delivery giants is that in case you have the customer data, share that with us. Of course, Zomato is saying that we will take customers' consent before sharing the data with you. But why essentially do restaurants want this customer data to start with?
Well, when you're subscribing for that convenience of food delivery, you're also subscribing to share your data as to your customer preferences, as to when they would like to order, what time do they like to order a particular kind of food, is what these apps actually take in. But this data will be shared with NRAI. They have been fighting for this for long. What they've said is that they will be using this data for marketing and sort of tuning it for the customers, keeping customer preferences in mind, and also build a loyal customer base, is what NRAI has said. And this long-running demand has now been fulfilled. But the question here is, this follows just after the DPDP rules have come through, and Zomato will need to go through a whole round of and take a re-look at how they will be sharing this data. Although there will be consent, they will also have to sort of employ customers the preference to also withdraw some of their consent. So DPDP rules will have to be looked at in more detail.
But will it still raise any kind of privacy issues for the customers, even if they, see, first of all, the key issue is that will it be easy for them to withdraw the consent? That's what you pointed out. The second part is, will it be also easy to select that I don't want to give my data and I would just want to proceed with what I need from the food delivery giant? Will it be easy? Second of all, will this continue to raise privacy issues in case the customers agree to give their consent?
Well, the DPDP rules explicitly say that you need to clearly define the purpose of the specific consent that you are giving as far as the data that you're sharing with some of these food delivery giants. So DPDP rules does demand that and gives the convenience to all of the customers. And the other part about withdrawing your consent, that is also part of the DPDP rules, that I should be able to withdraw my consent to share my data, to share my preferences and food delivery options, etc. All of those details I should be able to easily access as far as DPDP rules are concerned. But having said that, the prompts may have been sent to some of the customers. This is still an ongoing process. In fact, we reached out to NRAI, but they say this is still in the nascent stage, and with more details they'll get back to us in a couple of months or so. So far they've said this matter is very, very sensitive, is what we're picking up.
It is definitely very sensitive because it pertains to the customer's data Remember, like, a decade back or so, when, all these food delivery giants used to agree to share all this data, it was the customers who pointed out that their numbers are being used, their data is being misused because there's a lot of spamming that they are facing at this point in time. But remains to be seen whether all those issues will be ironed out this time around if this proposal has to go through. Thanks a lot, Aishwarya, for being, giving us all those details. Coming back to our conversation with Sharmila. Sharmila, first up, of course, we've been assessing all this while, the fundamentals and the kind of stock price and the opportunities that these food delivery giants go. This is another aspect completely, and this pertains to data like yours and mine, because we are now completely dependent on, these food delivery giants, quick commerce companies, and we use them on an everyday basis. In case, to save time, customers just go ahead and agree to, the consent of giving out the data. The big question will be, will it be misused or will it be protected going forward?
So that's $1 million question, because as we all know, data is like the new oil. And we are living in that world where we sort of strive to build layers of sort of protect our privacy and, stop our data from getting shared, etc. So I think the guidelines will get cleared as time goes by, because let's be honest that the convenience of ordering, sitting at home is too good to really pass up. So people will sort of take a calculated risk as to what is the data being served. They will try to circumnavigate, what is being shared, etc. There are plenty of smart people out there, and I really don't know if all the places we are ordering from are really in a position to use that data in any meaningful way. So let's see where this goes. But I think, yes, it's a very sticky situation, and I'm sure, as I'm saying, some middle ground will be reached where you will consent to what kind of data you would be okay with sharing.
Absolutely. So this debate has to continue, and this has to be definitely on the watch as, companies progress to definitely use our data for other purposes as well. But we'll have to keep an eye out on how things develop on that front. But let's also focus a bit on the primary market space. This space has been, booming for far too long now. We are already in this year so far had about over 90 companies that have come in the IPO space. They've raised about 1.5 lakh crore rupees as well. The big question is, are the retail investors truly making money? And all of us have been highlighting for you to look at what is going on with the likes of Grow, with the likes of Physicswala. Every day you've been listing whether these stocks are going up or down. The big question I want to ask you, Sharmila, is that, when there is a flood of IPOs, what exactly should investors keep in mind? The businesses seem to be good. The businesses also seem to be promising for the future. But at the same time, we have seen that it took time for even a Zomato or Swiggy to start performing. It took time, and thereby now we believe that, these are going to be a part and parcel of our lives for some time to go, and things will iron out, and finally they will see consistent and strong profits. How does one really identify strong companies from this list of IPOs that are coming in?
So, one straightforward way of doing it is that you have to look at whether it's an offer for sale or whether it's an IPO where the money is going directly towards some some either a manufacturing facility they are building or so on. Because in an offer for sale, you're really just giving an exit to existing shareholders. Then the process of whether you should be investing in the IPO or not becomes a little tricky, because you have to look beyond the kind of price that you're giving for that IPO, and think whether you, like for instance, let's take Lenskart. If you're giving an exit to the existing shareholders, which is fine, because these shareholders have, they have invested in a business at a very, very nascent stage, and they at that stage don't know which are the businesses that are going to make them money. So at this price, you have to evaluate whether what they are saying, what is the potential growth for this business, is that likely to play out in the next 4, 5, 6, 7 years, whatever, or not? Or is this just really the promoter taking money home? So that, I think, seems to be a sort of a tricky situation that we are getting into. Yeah. Having said that, if you have a very good IPO market, it's always good, because it sort of signals the overall health of the market, which is what we're seeing. The only thing is that we've had a lot of investors who used to invest in IPOs primarily for listing gains, and that needs to stop. So hopefully, some sort of, again, as I'm saying, some middle ground will come from all this, and people will analyze better when they invest in IPOs.
Fair point. Let's look at the market closing and come back to Sharmila with all those viewers' questions then. 3:30 viewers, it's in front of you. We are already seeing that the Nifty has slipped at about 0.5% lower. 26,063 is what we've seen the market shut shop at. And you look at all the sectors, barring FMCG, rest all of the sectors have slipped in the trade. Metals, real estate, PSU banks have lost a lot of ground in trade today, whereas minor losses can also be seen on autos, on infrastructure, on IT. That's despite the fact that some of the some of the auto names have actually climbed to record levels too. Look at Maruti Suzuki over 1% higher, the top moving stock on the Nifty today. Max Healthcare moved up 1%, Interglobe Aviation 1% higher for this one. Tata Consumer Products, Mahindra & Mahindra, these were the top movers as far as the trade is concerned. On the lower end, metal stocks, Hindalco, Tata Steel, JSW Steel, Bajaj Finance, these were the names that dragged in trade today. But let's start to look at some of the questions that are coming in from our viewers today. Sarthak from Delhi says, is it worth investing in Capillary Tech after today's listing, or should I consider the Sudeep Pharma IPO instead? Okay, from the IPO space again, Sharmila, for you, Capillary Tech, we did see a weak listing and thereafter the stock rebounded about 12% in trade today. Sudeep Pharma, in fact, has completely sailed through on day one itself. Any suggestion on any of these newly listed as well as IPO space?
So, first let's talk about Capillary Tech. It's a business that I like, but, having said, like, what we were discussing a little while earlier, I think it's best to let anybody who's in an IPO for listing gains to get out, the short-term investors. So my advice would be to wait for at least 45 days after listing. So maybe about a month or month and a half from now, and then look at Capillary Tech and see where the price point is, and then take a call. So between the two, I definitely prefer Capillary Tech, but as I said, I would wait for a month and a half before I look to buy into it.
Fair point. Let's look at another question, and this one is from Prerna from Mumbai. She says, amidst the global sell-off in AI-related stocks, I want to know, is it safe to stay invested in IT or Indian tech stocks?
So we haven't even started really where AI is concerned. So, I don't think that we should really worry too much about the debate at this point in time, because, we are talking of a company like Nvidia, which is, which market cap exceeds the GDP of nations. And, what are we talking of? We don't have a pure play AI. So I don't think that we are in a position to really start getting worried about this at this stage. Even if there is a bubble, I think we are out of that bubble.
Okay. Lastly, Arjun Singh says from Agra that between real estate and metal stocks, which sector looks more promising for booking profits ahead of the budget?
Between the real estate?
As well as metals.
To book profit. I think perhaps, to my mind, both sectors look good. But from a near term, maybe I prefer metals.
All right. Got that. Remember, viewers, we are actually also going to be looking at another key aspect now. So remember, we were talking about the US-India trade deal. From January 1st of 2026, the United States will increase travel and immigration fees as part of its annual inflation-linked update under the One Big Beautiful Bill Act. The parole fee allowing temporary entry into the US without a visa will rise from $1,000 to $1,020. The ESTA fees goes up slightly to $40.27, while the EV-US fee for Chinese B1 and B2 visa holders increases to $30.75. However, from I-94, the arrival and departure document for visitors will remain unchanged at $30. And additional updates also include higher remittance and visa integrity fees for select applicants. Any key suggestions, Sharmila, there? What will this mean for a large part of Indian visa acquirers for the US?
Well, not really. I haven't really given it much thought because, I think that the way I look at it is that people who are there for work are in any case sponsored. And so far, that bit I don't think is like the hike is too much to really impact anybody too much. But let's wait and see.
Okay. Thank you so much, Sharmila, for being with us on the show. It's always a pleasure to host you with us. And with that, viewers, it's a wrap on the Business Today show. And in case you too have any questions about investments, mutual funds, SIPs or stocks or gold-related queries, then please do send them on the number that's flashing on your screens. And with that, we wrap up this edition. See you on Monday.